Good morning, personal wealth management students. Our topic for today is the title is Other Insurance, and the idea is once we're down into the risk management process, or thinking about all the different risks we could manage, there are a bunch of different insurance products that can serve all the little different various things that could be happening, and there's lots of detail to know. And as a financial advisor, you want to be in a position where you can wisely counsel your clients on what kind of coverages they need and what are key provisions they should make sure that they get. In preparing for this lecture, I did learn quite a bit. So there's a lot to know. It's not they're not things that you could just figure out or guess by being clever. So there should be some good content here. So again, if we remember back to the last topic, we were thinking about risk management as a broad process where we incorporate all the potential losses or uncertainties a family might face, and then come up with a comprehensive program to manage those risks. And that can include insurance products, but can also include self-insurance or savings or investing or changing behavior. And so even though we're talking about insurance in this section, keep in mind, of course, that we are using insurance in concert with all of these other management methods, including self-insurance and behavior change. So that's going specifically addresses this first question, because when is it appropriate to insure something, and when is it appropriate to do something else? So there's kind of two key dimensions to think about. First of all, how severe is the loss in the event of loss? Right, a good example of something that can be, for many people, not a great idea is getting a phone insurance plan, right? So if I have two wage-earning adults late in their careers, the loss from having a phone need to be surprise replaced is really small relative to, the two incomes, and then there's a hassle that to claim, and then there's a deductible, and at the end of the day, all that trouble probably isn't going to be worth it for that couple. They can just self-insure, right? It's not a big damage to their personal wealth to have to replace a phone early. Whereas, for example, a college student working on a part-time job that committed a significant chunk of their own personal resources to get the latest model of iPhone. Well, now that's starting to be a big enough investment that maybe getting a phone insurance would make sense, because it's a much larger, right? The severity of the loss is big compared to what it would be for the other couple. So severity matters, right? If it's not very severe at all, you don't really need to bother insuring it. And frequency is another interesting one. So if there's high frequency versus low frequency. So a good example of a severe loss, a high severity loss with also high frequency, is dental care. So dental care is very expensive, but you can almost definitely count on it. Right, you're going to be doing dental care. You're going to be doing dental care frequently, and the variability the variability of dental care often cannot be that is often not particularly that high. There's exceptions, right? So if you have to do some very serious orthodontic work, right, getting your jaw broken, I mean, at some point it switches over to fall in the medical realm, but for example, if you wanted to do Invisalign that's not going to be a medical procedure covered by your medical insurance, but might carry a significant expense. But basically, the dental care is really expensive, but because it's so high frequency, basically you can almost count on it every year. Many families can avoid having dental insurance because you just know you're going to pay that money kind of no matter what, and do it. So now there's exceptions to that. So reasons to get dental insurance, I personally have dental insurance, is then there's a forced savings component. It also, depending on the nature of the coverage, it might be financially beneficial to do it. There's some tax implications. So with dentistry, there's kind of some other things, but I think dental care is an example of something where, because the frequency is so high, that actually makes it less likely to make sense to insure, right? If only one person in your family, you think about a family that's married with kids, like what if only one of those people needed significant dental care every decade or so? Well, for a very low price, you could get a coverage that would pay out in the event that they need to get that once in a decade big coverage event. And that would make a lot more sense from an insurance standpoint, because the low frequency makes it very difficult to plan around and would be a severe negative outcome for family finances if it does occur. And so in a way, it's kind of counterintuitive. So if we have high frequency, usually we just retain and then do a savings component, right? You might set money aside to cover the high severity, high frequency events. And then for low severity, high frequency, you definitely don't need to. But for low severity, low frequency, you don't need to either, because you can just sort of imagine yourself running your own blanket umbrella policy where you just say, okay, well, there's a million things that can go weird. None of them are very expensive at all. So I'm just going to have a generic, rainy day fund that pays a couple $100 whenever this random stuff happens to me. Right? It's the high severity, low frequency things that it makes a lot more sense to insure. Okay, some terms, when we talk about these high severity, low frequency things, they have a different nature to them. There are different kinds of risks that can come up that meet this criterion. So first is a business risk versus pure risk. So business risk is a risk taken for potential reward. Pure risk is a risk carries no financial reward. So, for example, I have a trampoline in my backyard. This is not a business risk. There is no reward there other than fun for visiting kids. But absolutely 100%, when I applied for my umbrella policy, there was a trampoline, do I have a trampoline question? And I had to answer yes, and it increased my umbrella coverage rates. So, this recognizes, of course, that people have a tendency to get hurt on trampolines, and other people visiting your house tend to get hurt and then possibly sue you for getting hurt on your trampoline. So it's a sort of a cost of doing business with a trampoline. I know I said it's not a business risk, but we use that expression there. So we have a risk that just, it's just a thing that increases risk. You'd imagine a lot of these, right? If I skydive, or if I do long solo hikes through the wilderness, or drive a high horsepower automobile. I mean, there's lots of just things that you might do in your life that carry risk with them without an obvious financial reward. A business risk would be different. I mean, so for example, if I operate a medical practice, that's me operating my business. I generate money from that business, but I also create a liability by doing it. And so those they just are tend to be handled a little differently for insurance purposes. So uncertainty is a term we use, and it just means you don't have knowledge of the outcome, right? If you know what's going to happen, then it's not uncertain, and it's not, and then it will tend to be uninsurable, right? Because if you know it was coming, you'd pay the premiums only when you knew it was coming, and that would make the insurance pool full of people who are about to charge against it, and that would make the insurance really, really expensive to where no one would want it. And in economics, we call this kind of a market for lemons. If it's knowable, then the only people that get it are the people we don't want getting it as a provider, and so it doesn't work. So you need to not know, the outcome. So uncertainty, we don't know it. A risk is, in insurance terms, is something where, again, it's uncertain, we don't know it, but we have a broad understanding of how often it happens, so we can plan around it, right? So the math of it is known, even if the individual outcomes are unknown, right? So I don't know if my house is going to catch fire, but I know over 100,000 houses about how often they catch fire. And that works great for fire, not so great for flood. So a perils are exposures to the risk of loss. So if I have my home in a floodplain, right now I have an exposure to a loss risk from a flood. So that house is in peril in a sense, right, along that dimension. And there's lots of things that can generate perils. Right? I mean, everyday economic activity generates perils, living life. So perils are just, right, exposures to risk of loss, and then hazards are exposure to increased probability of peril. So, so with a peril, we have some expected probability that the peril happens, and then a hazard adjusts that, right? So we have a couple different kinds of hazards. A physical hazard is a deficiency in physical property that increases the possibility of loss. So let's imagine that I'm insuring a home, but it has really outdated wiring. Well, that would be a physical hazard of the property, and if that was known, it would make it more expensive to insure probably. Right? So the physical hazard is just a physical thing that increases the peril, because the likelihood that it catches fire is now higher. So physical hazard, just the nature of the thing that's being insured. And a good example of physical hazards with people are they live in different places, right? So when I was in Arizona, I guess this is cars, so it's not people, but in Arizona it was more expensive to insure my car because they had, there's more auto theft in Phoenix than there was in, small town Wisconsin. So that's just geography, right? Being in a different geographic location was an increase in peril to my automobile. And you probably, I don't know if I told the story, but when I lived in Chandler, Arizona, a suburb of Phoenix. This is probably not telling. This is not the Chamber of Commerce is not going to love my storytelling here, but I had the water heater stolen off the side of my house. I just ripped it off and drove off with it. Somebody threw a lock through my window. They broke my car window and stole my $20 aftermarket stereo that I had to buy because my kid's stuff changed in the stock CD player. We had tons of stuff get stolen from our house in Phoenix, and so that it just was an increase rate. There was increased peril down there, so you get increased insurance rates. That's physical hazard. So moral hazard is hazard that arises from actions taken by the insured person which increase the possibility of loss. So just a really great classic example, right? If I have really good medical coverage, maybe I won't worry as much about going on a really aggressive trail mountain bike ride because it's going to hurt and I'm going to be laid up for a while, but I won't also be out a ton of money, right? But if I have pretty terrible medical coverage and I'm going to be out thousands and thousands of dollars if I take a spill, I might just not do the trail ride and do a road ride instead, right? Or some other behavior that's not as risky, right? So the existence of the insurance, if it makes me behave differently, that is moral hazard. Now notice this is right. I'm not maliciously doing this. I'm not trying to claim insurance maliciously. I just want to have fun riding my bike, and it's just something natural I do. And so that's the moral hazard part, right? We're behaving morally. We just we're just going to naturally behave a little differently under insurance coverage, right? Morale hazard is different. So this is behaving negligently because they have insurance coverage, right? So that's different. So I mean, riding a bike is not negligent behavior, right? This is when you're just deliberately being bad, right? And to some case, you can say, all right, so for example, maybe I have my house and I'm in the middle of constructing my house, and I supposedly have a couple $100,000 of materials into it, but actually I don't, and then I light it on fire and claim it had a bunch of stuff in it that is insurable. Well, right, so that's I guess that's outright fraud, but you can think of something not quite outright fraud, but where you have but it's negligent, and then you end up with problems. Okay, so that's moral versus morale there. Okay, so if insurance companies had perfect information, they would do lots of things differently, right? You could break everybody up into little classes and give everybody coverage and appropriately to their true risk level, and then at the end of the day, insurance would be less expensive on average because the people that truly are a danger to the system would not be insurable, and then they wouldn't do that activity, right? So if there's people doing really risky things that they really shouldn't be doing, if in a perfect information world, they would have to stop doing those things because they couldn't get insurance. But that's not how it works, right? So with asymmetric information, people tend to know a lot more about their stuff and about themselves than the insurance companies do. They have to kind of tease it out from the information that they get, but it's not perfect. So that means people doing, so if an individual may be operating in his life in its way that's totally uninsurable, might be insured anyway, and then sort of function as a bit of a tax on the system for the rest of us, right? And so with asymmetric information, insurers end up having to insure that the individual or property that has those problems, and then we all just sort of bear the cost of it, the people that are in this. And so, and as a result too, right, that makes insurance prices go up. Excuse me. Ooh. Which if I'm really, really safe, I might now not be willing. Excuse me. Oh, that's a long sneeze. I might not be willing to pay for that insurance. I drop out, and now you get, right, so now the pool of people in the insurance is getting worse and worse and worse, which makes the prices go up, which makes people drop out. And so that whole concept is called adverse selection, right? The people who apply for insurance or seek insurance could be different than the people who don't. And so even if the population broadly has limited to exposure to a particular risk, the insured population might have more exposure. And so these are all factors that insurance companies have to take into account when they write policies. And that's why it's beneficial, for example, to do things like group insurance. So if all of the train employees through their employer get together and get insurance, well, now they know that this train as a group sort of behaves a certain way, and the fact that they're from train means a certain thing, means something about them, right? And so in a way, because they've grouped together, it gets rid of some of the uncertainty, and so that can lead to lower rates. So you've got these, right? So basically, because they don't know who they're insuring or what they're insuring perfectly, they only know it kind of. The insurance company and companies have had to protect themselves and their customers from bad actors or bad risks. They've got basically some standards that make common sense, but are just basically universally applied. So first, insurable interest. You could only insure against loss that you yourself would suffer on, right? So I can't take out insurance on someone else's car, and then why? Because then I could drive into it and then get paid, and I didn't suffer any loss, right? Me driving into the car didn't suffer any loss. And maybe I drive into it and drive off. Nobody knows who I am, only I'm getting a big check, right? So you can only insure stuff that you personally lose from, right? You can't end up ahead, right? And there's a lot of these sort of get lumped into you can end up ahead, but that's the first one. It's really easy to get ahead if you're insuring something that you have no interest in, right? Then any money you get paid is just gravy. So that's insurable interest. You have to have an interest in it to be insurable. Indemnity, or maximum reimbursement in the event of a loss, is the value of the item, right? So I can't, get insurance on a classic car that I bought for $10,000, insure it for $80,000, and then expect that, right? And then what if it gets stolen, right? Scare quotes, right? What if it gets stolen and then I go try to claim $80,000? Well, that would be, right? Of course, insurance companies could do that. They could choose to insure that way, but they don't. Why? Because that just creates a ton of temptation for fraud. Right, so what they want to do instead is you bought a classic car for $10,000. Okay, we'll give you $8,000 because we want, even though it stings and we would really like to go up to $10,000. If we went up to $10,000, then it just increases. Right? What if we're off a little bit by that value estimate and it's really only $9,500? Now we've wandered into the you can make money filing claims territory. So they want to maybe pad it a little bit. But regardless, you want to make sure you're not making money off turning in claims. Screening and segregation of applicants, right? So we touched on this already. We want to separate people based on their risk categories, and that can be really sort of interesting. I know a good example of this you might not think of is if you have a car, and you're required to list the color of your automobile. In most cases, and if you list a color that's not one of the stock colors available from the manufacturer, your insurance rates go up. And why? Well, people who have custom paint jobs in their cars drive differently than people who don't, and right, in general, probably more aggressively and have higher claims. So having a custom paint color gets you higher insurance rates. So this is a segregation of applicants. The custom paint people behave differently than the not custom paint people, so you can't do custom paint and expect to get the same insurance rates. But insurance companies do this over lots of different dimensions, right? So deny coverage to people that are bad risks and then charge different rates for different groups. Deductibles, this is another way, right? So you don't insure all the way. You say, okay, well, the first $500 are your responsibility. After that, we'll take care of it. Or the first $300 or whatever that number is. And the idea is that way, you have a little bit of, right? You suffer a little bit of loss. You don't get frivolous claims, and so it reduces overall claims, because if it's something that's not very big, then you just won't file on it. So in a way. And this makes sense from the customer standpoint too, because you're getting insurance for the big losses. You don't get insurance for the little losses. So if a little bit of loss reassures the insurance company that you're not just going to ding them all the time, then that can be really cost effective for you. Where you say, okay, well, in the event that this happens, I pay $500, but maybe I'm saving $500 in my premiums every year. Or over a couple years. And so it can end up being cost effective for all parties. Okay, coinsurance. So this is the policyholder pays a certain percentage of the outlay along with the insurance company. This often occurs in health insurance, right? So you say, well, 20% of your medical bills are your responsibility, 80% are our responsibility. Something like that. And so you pay along with your insurance company as you go up in bills. Exclusions, eliminating certain conditions from insurance company payout when a new contract is drawn up. So we're excluding something from being covered. Waiting period, right? So this is, I've just got coverage, but we're not going to pay out for, the first 3 months or whatever, so that you can't just, right? So let's say you're hard up for money, okay, I'm going to insure this, and then 3 days later, I'm going to torch it. Well, right, so having a waiting period means that isn't possible. You'd at least have to plan ahead enough to do it. pre-specified limit, establish the amount of the insurance company is willing to pay contractually, right? So you can have an upper limit on how much they're willing to pay. And then you might need a separate policy to exceed that limit. And so the next one, okay, so experience-based alteration and policy costs. So changes rates to policyholders based on their loss experience after they have become clients. So this is, again, for example, auto, right? You might get a cheap rate, but when you start crashing cars, it goes up. I had a friend. We knew each other in high school. I ran into her again in like her mid-20s or something. She had completely totaled, I think, 3 automobiles within 12 months, and they were like minivans. I think she basically she could not get auto insurance at all. It was just, she'd established that she was a terrible, terrible driver and just shouldn't be driving anything. And I don't know. It might have just been horrible, horrible bad luck. But at the end of the day, the insurance company isn't really excited about taking on the risk of somebody who crashes 3 cars a year, right? There's no price at which that makes sense for them to do. And I mentioned group policy. A group policy is where you have a group of employees or a group of people that get stuff together. And so since they're doing it together, there's kind of can be collective knowledge about them, and whatever individuals that could be problematic, it doesn't matter because they're pooled in with the group, and the group can approach insurers and say, you either get all of us or none of us, right? So in a way, it's kind of you can think about it almost like a union, right? So we have as a union of individuals negotiate as a group for insuring the group, and that means the couple of us that are maybe not, or would prefer to be not insured get insured anyway, because they're in with the group. Okay, even more terms. Mutual insurance is where the policyholders own the company. This is a pretty common organizational structure. They tend, empirically, mutuals tend to do better on a lot of things like customer satisfaction. And the idea is, right, it's run just like a regular corporation. You have a board of directors and everything. It's just the stockholders are the policyholders. That's different from a stockholder-owned company where anybody can invest in it, and it's just run like a regular corporation. I think the danger with a stockholder-owned company historically was thought to have been that, right, if we have stockholders, they might, for example, want to take money out of the pile of money that's there to pay out claims, and then there's not enough money to pay out claims, right? So, and that would mean, right, if I'm a person looking for life insurance, say, I might be nervous about a stockholder-owned insurance company because I don't know if the stockholders aren't just going to raid the war chest, so then there's no money for me. With a mutual, I don't have to worry about that. That's sort of avoided. So to the degree that people feel like a mutual insurance company is safer for their money, that means it can be a more attractive product and they can have an advantage competitively in the marketplace. So this, this tends to go back and forth, but it is sort of unique. Or than that, we don't interact with a ton of, as a farmer, you have cooperatives, right? And maybe we shop at the People's Food Co-op, but in general, the cooperative sort of organizational structure is not all that common in our everyday life. But insurance, this isn't a cooperative, but it sort of functions similarly, where you have individuals that are owners in the stock that are the customers. Insurance is just one place where it pokes up, and I think it's because of this sort of concern about the shareholders just raiding the money. So let's talk about how you would sit down with with some clients and think about what they need. So some of the many factors to enter into household decision making include, right? So general characteristics, the term. So like what are they need to have be insured, and what could be treated more as like a luxury, right? So this is based on perceptions of the house, like what do they perceive that their needs are, and what do they perceive as not necessary. So right, for example, you can imagine there are some risks that maybe that the households just would not perceive to be worth insuring, but that's going to be based on the individual by individual basis. That ties into the tolerance for risk, right? So if I have a really low risk tolerance, that means in general I'm going to want to be insuring more things, because any uninsured risks are going to introduce uncertainty into my income stream. And if this unusually annoys me, then that means I'm going to be willing to pay more for insurance products to get rid of it. So I have my risk tolerance and also the personal likelihood of occurrence. Right? So if we're in a situation where the different family characteristics mean we're more likely to get it, that makes us more interested in insuring it. Okay, so I'll pause for now, and then we'll pick up with the second segment, where we'll think about crafting an insurance portfolio appropriate for the risk management objectives of a family.